Good afternoon, everyone, and a very warm welcome to all the participants joining us today. I am Vikas Vasal, your session chair for this session on banking and insurance. I am the National Managing Partner for Tax with Thornton Bharat. Friends, today India is the fifth largest economy with GDP of $3.3 trillion. Soon, we will be a $5 trillion economy and a force to reckon with on different parameters. For any large and growing economy of the size of India, a strong and robust financial services sector is a prerequisite. Banking, financial services, and insurance. These are not only the engine, but also the fuel for the genuine growth of any economy. And they are also a sound and good barometer to showcase the overall health of any economy. Therefore, today's topic is very apt and relevant, and I have the honor to moderate a very illustrious panel. Our panel will deliberate on some of the topical issues and what they foresee as the future and growth opportunities. Therefore, let me introduce my panel members. Dr. Engen, Economics Strategy Unit Chief with US Embassy, Ms. Shanti Ekambram, Group President and Whole-Time Director Designate with Kotak Mahindra Bank, Mr. N.S. Kanan, CEO and Managing Director, ICICI Prudential Life Insurance, Mr. Amit Gupta, Executive Vice President and National Head Institution Business SBI Funds, Ms. Parul Verma, Partner with Kochar and Company, and Mr. Khushru Panthaki, Subject Matter Expert and Chartered Accountant. Friends, recently, the Deputy Secretary of US Treasury, Mr. Vali Ademo, was in India to meet the business delegates and the government leaders. And he wrote a very interesting and thought-provoking article in the Economic Times, which was last month only, wherein he mentioned that the importance that US and India are going to play in the growing world economic order. And his article was titled very aptly as Turning on the India-US Nexus. And he deliberated upon three important subject points. First, energy security. Second, economic opportunity. In fact, that is what we are going to deliberate upon today. And third, reinforcing the open economy. He made a very interesting observation, and that intrigued me. He mentions, quote unquote, together, the US and India form one of the central axes of the world economy, critical vector for the exchange of goods, services, talent, and ideas. Then he mentions that we must work together to reinforce the approach to economic development and cooperation that has made the axis so wide. And in the end, he concludes, the world economy is at a turning point. Its outcome will depend in no small part on the economic relationship between the two countries. What a remarkable observation that the future world economic order and the policy will be determined and shaped by what US and India decide today. With this, let me open up the session for deliberations and invite Dr. Engen from the US Embassy to share his perspective. Over to you, Dr. Ryan. Dr. Ryan, you need to unmute. Yes.
Oh, yeah, sorry, trying to get the unmute button there. So thank you very much to the IACC and also to you for organizing this event. From our perspective, we consider it to be quite important and we're happy to participate. So in my remarks, I'd like to first explain what I perceive as the larger policy and economic context for how we see India. Second, discuss why we think getting banking and insurance right is critical for India being able to realize its full economic potential. And third, I'll discuss some specific policy areas that we view as foundational on the banking and insurance side of things. So first, looking at the larger policy and economic context. So we view India today as very much like China in the 1990s. Just as China experienced explosive growth over the last 25 years by becoming the factory of the world, India has the potential to do the same over the next 25 years. From a policy point of view, we very much want India to take a larger leadership role, both in the Indo-Pacific and globally. To do that, it needs to grow tremendously. There seems to be little doubt that India will become the world's third largest economy quite soon. But how quickly this happens and whether India reaches its goal of becoming a developed economy by 2047 will, to a large extent, depend on whether it makes the right policy choices today. Fortunately, we're starting from a good foundation. Just last week, in the last period of time, we concluded the Indo-Pacific Economic Framework Ministerial in the United States, in which India is now a participant in 3 of the 4 pillars. This will very much be the foundation upon which future economic cooperation between India, the United States, and the rest of the Indo-Pacific partners takes place. So why does banking insurance matter? So getting banking insurance right, from my perspective, are prerequisites for everything else India hopes to accomplish economically. The banking sector allocates capital where it needs to go, and insurance helps manage the risk. I'm confident that once these 2 cornerstones are properly placed, India will naturally rise to become a new economic superpower, as it should. So in the United States, our financial insurance sector has tended to follow a very familiar and sometimes painful cycle. So it starts out being boring and stifled. Then at some point it liberalizes, then it grows, and it becomes one of the most dynamic sectors of the economy. Then it starts to get a little bit crazy and triggers some sort of financial crisis. And then there are calls for reining it in. And then it becomes boring and stifled once again. So this is not a bad thing, but actually a natural process. And there is also nothing wrong with the financial sector being boring. A Canadian financial regulator once quipped, compared to the United States, the financial sector in Canada is quite boring, but this is a feature, not a bug. Of course, the private sector doesn't like this, but from a public policy perspective, it is sometimes exactly what is needed. I've spent the bulk of my career working on issues related to China. Its development occurred in 3 phases. Phase 1 was getting on everyone's radar as the next great global opportunity. Phase 2 was globalization of its financial services industry. And Phase 3 was its growing its domestic market by becoming the factory of the world. Some experts say that around 80% of China's growth can be attributed to the role it has played in global supply chains. China has lifted more than 600 million people out of poverty in the last few decades in exactly this way. And from our perspective, India is poised to do the same. I think we can say that India is nearing the end of Phase 1, getting on the world's radar as the next great opportunity. Right now, when the world thinks about India, it sees almost limitless potential. Everyone knows it is early days and they will want to get in on the ground floor. Phase 2, the globalization of the financial services industry, is going to depend upon creating a conducive environment for the internationalization of financial services. While I don't have a crystal ball, I would not at all be surprised if over the next 5 to 10 years, there is a massive ramping up of the already nascent presence of multinational financial services in India: banking, insurance, accounting, and consultancies. If Phase 1 and 2 proceed well, Phase 3, becoming a global superpower, will occur almost naturally. So what are some specific policy areas we view as foundational on the banking and insurance side of things? So with this broader context that I previously described in mind, what specifically are we hearing as the main things India needs to focus on, specifically with respect to banking and industry? So before I go into the specific recommendations, I want to emphasize that none of these are the official position of the US government. I'm speaking in my personal capacity here based upon what we've been hearing from our contacts. It is not the United States government's place to tell India what to do. We have total confidence in India's commitment to realizing its economic potential, and we trust that India knows far better than we do what it needs to do. So with that being said, what are the main things we are hearing from our contacts? First, India needs to make itself easier to work with. I'll be blunt. Everyone sees and understands India's potential, but internationally, there is a reluctance to engage because doing so is never easy. It's not easy at the government level. It's not easy to get in. It's not easy to operate here, and it's not easy to get the money out. All of these things profoundly matter for investment decisions. The tip of the spear of India's reform efforts should be getting financial services right. If it does, everything else will naturally follow. If it doesn't, little else will follow. Second, India needs to expand its administrative capacity. The people who work for the Indian government are undeniably brilliant, among the best in India. But they frankly remain too small relative to the size of India's economy. Their heart is in the right place. They have the right ideas. They just often lack the administrative bandwidth to do all that needs to be done. Beefing up administrative capacity on financial services is a prerequisite for everything else. Nobody is calling for armies of regulators, but a multi-trillion-dollar economy needs a financial administrative capacity to match. Third, India needs to close the talent gap. India obviously has an enormous labor force, and it is enjoying arguably the best demographic structure of any major economy in the world. But the question international investors are asking is, does it have the labor force they need to shift their supply chains here? The honest answer is not entirely. Foreign firms feel the need to expend tremendous resources training the workforce to operate at international levels. This adds to their cost of production and makes them reluctant to invest in the first place. This is equally true in financial services. Fourth, India needs to expand financial services to women and marginalized communities. We view the two primary potential drivers of growth in India over the next 25 years as one, as discussed before, becoming a new hub for global supply chains, but in a way that doesn't destroy the planet in the process. And two, empowering women and marginalized communities, moving them out of the informal sector and into the formal economy. India's greatest asset is its people, but it needs to harness all of its people if it is to realize its full potential. These two alone, supply chains and greater inclusion, are likely sufficient for India to realize its economic goals. Everything else pales into insignificance compared to the magnitude of these two drivers. Fifth, and lastly, get the regulatory environment right, especially on digital financial technologies. Common issues we hear include financial reforms and repeal of the retroactive taxation, enhancing regulatory transparency and certainty, equal regulatory treatment of foreign and domestic banks, and perhaps most importantly, expand digital financial services. Again, to use China as a counterpoint, it has effectively become a cashless society. And through its suite of digital tools, any entrepreneur, even one in the smallest village, can effortlessly sell not only to the entire PRC market, but to the entire world. In conclusion, there is little doubt that India today is like China in the 90s. Those who are here today have gotten in on the ground floor of what no doubt promises to become the world's next economic superpower. Our job, the public and private sector alike, is to help India realize its full economic potential. We in the US government are 100% committed to this goal and hope to be a close partner during the next 25 years when India undergoes this profound transformation. These are exciting times, and whether all of this happens depends almost entirely on first creating a favorable banking insurance, accounting, consulting, and other financial services environment. If we get this right, I believe the rest will naturally follow.
Thank you very much, Dr. Ryan, for an interesting message that you gave us and some of the points. First and foremost, easier to do business. I think government has been government has taken a lot of steps in terms of making ease of doing business in India on different parameters, manufacturing, financial services, and others. Second, you mentioned about building up the administrative capacity. Again, there are a number of initiatives which have been launched to make sure that there is equal representation from the private sector on different policy making decisions as well. And lateral placements have also started at the higher levels in the government. But yes, it's a long journey. Closing the talent gap, I agree with you. We face this discussion and often it becomes a point on the lighter note when we say that a population of 1.4 billion, we are still struggling to fill in the gaps in different sectors, especially IT, ITS, and various other knowledge-based sectors. I completely agree with you, sir, on the message that you gave to us in terms of diversity and inclusion and women representation. I think there's a lot that has been done in the past, but yes, it's an area there where we need to focus more upon. And last but not the least, in terms of the regular reforms, especially in the financial services sector, I think that will help us grow even further. And in your words, to become an economic superpower with the right policy choices that we make today. Thank you very much. Let me dive straight into the panel discussion, which will be in the Q&A format. And Shanti, let me come first to you. Indian banking sector has gone through a lot of turbulence in the recent past. NPAs, followed by a pandemic, which has its own challenges. And there are now interest rates going up across the world, including India. And there is stress in different sectors, especially hospitality, tourism, and various others. And there is a fear that there could be more loan defaults as we go along because of various issues domestically as well as what is happening at the global level as well. What's your take on the current health of the banking sector and how do you see the future?
So Vikas, a lot of what you talked about just now happened during the COVID period. What happened during COVID was a lot of the contact services, which is hospitality, tourism, etc., got impacted because people were sitting at home and they couldn't go out. So they naturally got impacted. The banking sector did go through a little bit of stress, particularly in individual loans and some of these small and medium enterprises. But I think 2-3 things. One, the government stepped towards what you call the emergency credit scheme for small and medium enterprises, which resulted into about 3.5 lakh crores being pumped into the system right through the banks, but the government giving a guarantee, has actually helped organizations and companies survive. And as the demand came back, you are seeing them thriving. Second, during this period, a lot of the banks cleaned up their balance sheets, raised their capital, right, and prepared for what they call the post-pandemic world, including, looking at technology and how do you reach out to customers. So I think if I look at the banking sector today, I think they are adequately capitalized. The balance sheets have been cleaned up and they are in a much, stronger position to grow. We've seen in the last 6 months that the demand has come back significantly, perhaps as they call revenge spend. So whether it is travel, whether it is consumption, whether it's education, whether it is, a hotel and leisure, you've seen a lot of it come back. So I think, yes, we went through the phase during the pandemic. The banking sector, being the underlying holder of the economy, did go through that brunt. But 2 things happened, or 3 things, government scheme, second, banks cleaned up, and third, a lot of private equity and capital came in, which helped over-leveraged companies deleverage. You saw the boom of the IPO markets in which a lot of companies raised. With the result, even the corporate sector today is sitting on relative lower leverage and capital to invest for the next phase of growth. So that's how I would say. I think the health of the system is fine. Yes, rates have gone up. That is inevitable. given the policy and the inflation environment. But growth has not stopped if you looked at the last few months. Maybe we might see a marginal dip in growth, but still at about close to 7% growth, India will probably be one of the best growing economies in the world. And I think there's adequate capital available for good banks who have good, prudent underwriting policies. And one can certainly see the demand going up.
It's very comforting, Shanti, to hear from a person who's at the helm of one of the largest private institutions in the country that banks are cleaned up, balance sheets are adequately capitalized. Banking sector is transforming, and we all know that. A lot of changes we have seen over the last 1 decade or so. At the same time, it is also getting disrupted because of the advent of new technology solutions, and especially the fintech companies which are coming up, or the new tech companies as we call them. Though it's difficult to predict the future, how do you see the coexistence of the whole ecosystem developing fintech, technology, and banking, Shanti?
So firstly, I think the pandemic changed something permanently. It leapfrogged what I call the digital revolution. It was always there even pre-pandemic, but if this had not happened, it would have taken another 5, 6, 7 years for it to reach this kind of level. If you remember, post-demonetization, payments took off, and India today with UPI is one of the largest, digital payment systems in the world, which they just democratized payments. But I think the pandemic leapfrogged digitalization. People were sitting at home, they needed to buy, they went to online sites. They needed to pay, they paid online, right? Whether through their cards, whether through, UPI, whether through net banking, through transfer of funds. So I think the banking sector has very much, evolved in terms of providing technology solutions to its customer. The pandemic did another thing. It moved the power to the customer. The customer has a choice. When the customer visits an Amazon, a Flipkart, or any other, and they see the experience, they want the same experience with their banking partner. And that's where I think financial technology companies saw the opportunity, because they really focused on the experience layer. Remember, banking is a regulatory environment, and you have strong regulation front, middle, and back. So some of these financial technology companies really focused on a great experience, given that customers were going digital, and brought up with a lot of solutions. So my belief is it is actually a great collaborative opportunity. You can't survive just on experience, and you can't survive just on trust, as the customer is changing and the behaviors are changing. So the combination of trust, reach, technology, experience is what the customer is looking for. And it's very clear, if banks do not organize and make sure that they focus on the right customer experience, put customer at the center and become a technology company, they are going to be having a very tough time. So I think it's an evolving enterprise. You're talking about a regulated versus an unregulated environment. I think the regulator is now seeing how they can bring everybody within the regulatory environment. But digital is here to stay. Technology is here to stay. Customer behaviors have changed. I think there's a great collaborative opportunity, and banks have to measure up and make sure that they focus on the right customer centricity.
Great, Shanti, you gave me another point. I think we have been debating that probably consulting organizations will become technology consulting organizations in future. Now you're giving us another food for thought that probably banking will also become banking technology companies. Very interesting. Digital revolution, and customers have a choice and a benefit. I think these are two key messages I'm taking from this discussion in the last question. Let me change tracks and come to insurance. Having got the necessary comfort from banking from Shanti, let me come to you, Kanan. Culturally and habitually, we as a nation have not embraced insurance the way it should be. Life insurance typically has been sold as a tax savings instrument, and I'm equally guilty being a tax professional on that. Section 80C has always been there, a popular section where everybody would buy an insurance just to make sure that we get the necessary tax benefit. The pandemic changed the thought process, at least in a large section of the population, and now life insurance and health insurance and other kind of insurances are being viewed from a different perspective. Having said that, still the penetration of insurance on an average is in low single digits in the country, whereas in the more mature market, it is high single digit or even in double digit. So where do you see the insurance sector today in terms of penetration, and what we can do as a nation, regulators, or the insurance service providers to increase this penetration?
Yeah, thank you. Good morning to all of you, and thanks, Vikas, for these questions. And I also thank IACC for inviting me to this panel discussion. The first part of your question, you talked about insurance being sold as a tax-saving product. So the way I look at it, Vikas, is that over a period of last over 6 decades, insurance has generally been sold as a saving instrument in general. I talked about monthly or annual savings, regular savings being forced out of the customers, that being invested for long-term investments. And finally, whenever the customer needs or customer's family needs, you have a financial security coming in the form of a kitty of investment or long-term investment. I would say that, yes, tax saving sort of propelled it somewhat, because there is always an incentive, especially for the salary customers, to get a little bit of an ATC kind of benefit. So I would argue that as a developing nation, trying to get the family financial security for the citizens, it's not a bad outcome. That's how I will present it. And over a period of time, regulators also added layers of protection to the insurance, a minimum cover, and so on. So as a result, even if you look at in the last 2 decades, the premiums have increased by 13-fold. And if you look at the sum assured as a percentage of GDP, because sometimes we get carried away with the premium collection from the customers, but what I think is more important is what we give back to the customers in the event of calamity. That is how the penetration should be measured. So the sum assured to GDP was 50% in financial year 2002, and in financial year 2021, we got to 95%. So it's not bad. So it's doubled as a percentage of GDP. But having said that, if you look at some of the developed countries, it'll be probably 200% of the GDP, etc. And we have a long way to go. And that's the context in which you mentioned the second part, which is the pandemic-related sort of need for insurance. You're absolutely right. While the savings side has done quite okay, the term cover has been hugely underpenetrated in the country, the term insurance. And the pandemic, as you rightly said, has only enhanced the need amongst the customers. And we have also seen it in terms of our own the logins, inquiries for new policies, or if you look at the search engines, the word term insurance, the way it is being searched during this period, it has been phenomenal. So I do hope that we don't get complacent over a period of time, and the learnings of the pandemic in terms of having to cover ourselves much more than what we have done continues. That's good for the country as a whole. So if you really look at the areas where there has been some positive movement, and to answer the last part of your question, what can be done going forward, is really one area where I'm seeing a lot of movement is the group term insurance. So in the organized sector, especially with the employer-employee relationship, lots of big and medium corporates are getting acutely aware of the lack of insurance for their employees. And the pandemic has only emphasized this point, that the number of employees being covered by large corporates and the extent of coverage per employee, both were very inadequate. So we have seen in our own business and for the industry, a huge movement in the group term insurance. And there's a nice way to cover larger segments, especially in a vast country like India. Going through the employers and doing a group insurance is a quick way of getting up to speed on insurance coverage. That's one area where I think more can be done. There's been some movement I'm seeing. The second is the Prime Minister's scheme, PMJJBY. That has really enhanced the awareness of insurance in the country. So I understand that there are about 6.5 crore members as of April 2022. It's a minimal coverage of about 200,000 at a price, and the regulators have also made the price a bit more viable for the industry as well. And it's a nice way of ensuring that the viability of such products stays, and more customers can be covered in the future. So this kind of schemes as we move forward is a second area where there can be a lot of movement. The third is a general awareness campaign, because in a country like us, more and more awareness needs to be created, and learnings of the pandemic have to be sustained. And you don't get suddenly complacent that this will come and this shall pass and life will go on as usual. We should not get into that kind of a mode. So the awareness campaigns are critical. The insurance councils have done a lot of effort. The regulator, IRDA, is doing a lot of effort. But I think sustained campaign is a requirement, especially for a country like us. And the fourth area where I would say is, taking off from Shanti's points also, that the reach to the customers is more critical, especially in an insurance space. It continues to be a push product. So you'll have to make sure that it reaches the customers. The role of distribution cannot be underestimated. The agents, the bank partners, the corporate agents, brokers, web aggregators, etc. on one side, and technology leveraging on the other side. I think that is very critical, especially for a country like us. And the good news is that the ecosystem for financial services technology is exploding. Shanti talked about the fintech. And similarly, there is a lot of ecosystem development has happened in the form of Aadhaar, account aggregators, Vahan, health data. If all this can be aggregated, and there the regulator has taken the initial step forward. So if this whole thing ecosystem can be integrated into a technology-based delivery of insurance, that would be phenomenal in addressing this underpenetration. And last, somehow we always complicate a simple insurance product. So some kind of a product simplification and telling the customer very clearly, or packaging the product in such a way that the customer clearly understands what happens in such specific events. And that will again go a long way in demystifying, so to say, the product, and then making sure that the adoption, to answer your question, becomes higher and higher. These are the initial thoughts I have in terms of tracing the industry, where we can go from here. Thank you.
Great points, Kannan. And I think the point that you mentioned about the regulations, and Dr. Rayan also alluded on his initial speech, I think that is one area now I'm going to touch base upon. Insurance is a very important, but also a very sensitive sector. And that's why it is highly regulated. Over years, the FDI limits in insurance have also been increased to invite the foreign players. And I think more liberty has been provided to the insurance companies in terms of the products and solutions to be offered. However, still it continues to be very much driven within the four walls of the regulation in terms of what can be done, what cannot be done. How do you see the current status of the regulations, and what more can be done in this context to make it more business as well as user-friendly? As you rightly mentioned, simplify the policies, and I think for that the ball lies in your court, to make sure that we have very simple term insurance products.
Yeah, because the last point first, yes, of course, I'm not saying that the simplification agenda is just for one stakeholder. All of us will have to, bring all our ideas together and make sure it happens. Right. So, and going back to the larger question you said, and also I'll probably address the first and the last fifth point Dr. Rayan made. The first one is on ease of doing business, and the last one on the general regulatory environment. I'll also try and weave in those points in the context of insurance. The first, you talked about the FDI limit, in the insurance sector. So obviously at the time of liberalization, we took some baby steps as a country, as a regulatory environment. The FDI limit was at 26% at the time of liberalization. Then subsequently in the year 2015, the country increased it to 49%. And more recently, it has gone to 74% in 2021. So I would say that this is a great move. On one side, it's a calibrated move. On the other side, 74 is an outstanding number, even from the international investors' perspective. So this is something which I would also use this forum to urge the foreign investors to look at this insurance industry, Indian insurance industry, in a favorable light and invest more. And more significantly, I would say one change which has probably not got publicized a lot is in the 2021 change to the regime of Indian controlled and Indian owned. I think that regime has been completely diluted to make sure that there are very light conditions today for foreign investment in the form of just having a majority in terms of board representation or the key management personnel, majority of Indians. That's about it. All the other norms with respect to tight control by Indian enterprises, all that has gone away. So I think not just that the ownership level has been increased to 74%, but the associated control requirements have been fully diluted. So it's a very calibrated opening up, and this is something which is not publicized so much, but I would urge that the international investors really look at this and look at Indian insurance industry as a favorable destination. Second, on the regulation itself, this is more like a government measure. But if you look at the regulation itself, I would also agree with Shanti that even in insurance industry, given the policyholders' protection requirements, it has to be tightly regulated and it will continue to be tightly regulated. So I think we cannot escape regulation when it comes to insurance in the country. But on the other hand, this, especially in insurance, it has withstood the global financial crisis very well. We have had a few cycles, credit cycles. And if you look at the insurance industry, the NPAs are next to nothing, not even like banking industry. So that lot of credit goes to the regulation because there are some minimum requirements of where we can invest, where we cannot invest. So that does, the industry has acquitted itself extremely well, I would say, across the credit cycle, particularly during pandemic and earlier during the global financial crisis. And if you look at COVID-19 time, when customers suffered in terms of not being able to, go out to buy policies or because of lockdowns, etc., the regulators also took several steps to ease the buying and using technology, dispensing with certain regulatory requirements on wet signatures and so on. So steps have been taken from time to time is the second point I want to make. Third, again, this will address the first point made by Dr. Ryan, that recently the regulators have talked about their own agenda for insurance going forward. They've said the first is the growth and development agenda. IRDA as insurance regulator is called here Insurance Regulatory and Development Authority. I think true to that name, the chairman of IRDA has articulated that by 2047, with this 100th year of India's independence, he doesn't want anybody to be without life insurance or no family be without family health insurance. So this is the agenda. The first agenda of growth and development has been articulated. And the second agenda he has articulated is the ease of doing business. So the regulator feels that without doing delivering on ease of doing business, we cannot fulfill the growth and development agenda. And I'm very happy to note that some of the recent steps taken by the regulator means that they are really walking the talk. For example, in respect of several products, they have dispensed with the prior approval requirement. Instead of file, get it approved and use, they made it use and file. You manufacture the product, use it, and then file it with us, whether you have complied with everything. It's a great step going forward. They have put out a lot of exposure drafts on intermediation, relaxing the intermediation, relaxing the expenses of management, the commission, and the other forms of capital, which is a great thing. They've also put on the mission mode 5 agenda they have articulated for themselves: movement to the risk-based capital, movement to IFRS, movement to risk-based supervision, InsurTech, and also strengthening the grievance redressal. I think all these areas, they have carved out verticals within the regulator and put them on a mission mode. And in the next year or two, I do see a lot of movement happening in this regard. And the last part I would say before I close this topic is around the Bima Sugam, which has been reported widely. They're talking about an end-to-end common digital platform for insurance companies to sell, customers to buy, intermediaries to interact with the customers, and getting all the servicing done, including the claims. That end-to-end platform is being facilitated by the regulator. And the idea is that through the regulatory sponsorship, this whole platform can get access to the ecosystem, payment ecosystem, health ecosystem, which I talked about earlier. If the data is available to this platform, insurance can be delivered in a meaningful manner or a much larger, better outcomes going forward. So we are in a good space. We have an enabling regulator with strong growth and development focus, coupled with ease of doing business being delivered to the industry. Thank you.
Great thoughts, Kanan. Enabling regulator, regulations that are working, and every family to have an insurance, especially health insurance. I think wonderful scenario. Right steps being taken. And Khushbu, before I come to you on the IFRS point, which Kanan raised, and to Amit, to make us financially rich, all of us in the capital market, let me go back to Shanti on one particular point. Banking sector must be financially strong, robust, adequate regulations and flexibility, adapting latest technology to achieve India's true potential. We know that US has got one of the largest banking and financial services sector, and there are a lot of things that are taking place over there, which provide a lot of comfort as well as some questions as well on that. Shanti, where do you see there are areas for collaboration between US and India on different parameters to make sure that the two largest democracies and their people actually benefit from this collaboration. Shanti, you are on mute.
Apologies, I didn't realize that. So 3-4 areas I think where US-India can collaborate. Clearly, we are one of the largest trading partners with the US, and the whole underlying financing of trade is a big area of opportunity. Second, India needs and is building out a lot of infrastructure. Long-term EXIM infrastructure funding and capabilities around it is something that the US certainly can help India in provide, apart from providing base technologies itself, financial technologies itself, long-term infrastructure financing. One of the biggest things about Indians is that, you have one very strong in export of services, but as Dr. Ryan mentioned that, also the export of goods, which is manufacturing goods. A lot of the technologies, which again, banks can provide, environment and financing, I think US companies can come here, set up, provide, as well as, there are opportunities to finance the same. US is one of the largest Indian diaspora, which you see a huge remittance corridor, right? Which all banks on both sides, there is ability to service the diaspora as well as grow it and see how we can make it very big. A lot of Indian kids go to the US education. And if you look at the last 5 years, it's one of the biggest opportunities is that, higher education. But I think US can also help set up universities over here. And we can see how to make this even more robust in terms of a partnership on the education sector, which India needs badly. There was a talk about needing to skill India. And I think this is where, US can help a lot. The banking system plays a role in each one of these areas through financing, through services, through education loan, through many of it. So I think there are a number of areas where US and India can partner, where the banking sector can play a great opportunities with technology at the core and increasing the flow of, engagement between the two countries.
Great thoughts, Shanti. Thank you. Long-term infrastructure finance, technological collaboration, and the role which Indian diaspora can play. In fact, as per estimates, multi-billion dollars, depending on which year you're looking at, $60 to $80 billion go into the country. And Indian diaspora actually plays a very important role, not only in terms of the collaboration between the two governments, but also being as part of the government administrative machinery today in the US. Great thought. Now, Amit, since the money has flown into the country, right, from Indian diaspora and otherwise, and we have a lot of optimism from Shanti on the banking sector and Kanun from the insurance. So how do you make us rich? So my question to you is, traditionally, we as Indians have been savers. There's no doubt about that, okay? Irrespective of what level of income a person may be or household may be, there is a part which is put into the savings, either in some box or in a bank, depending on what your financial conditions are. The saving rates is approximately 13% on an overall basis, which means that multi-billion dollars get saved every year. However, traditionally, all our savings, and that is also supported by a recent RBI report, goes into primarily real estate or into gold. Our love for gold is both good as well as bad in terms of foreign exchange as well. However, the younger generation is more tech savvy, is adopting to more financial products. So where do you see the sector standing today, and how do you foresee the future for all of us?
So thank you, Vilas, and thanks IACC for having me here. A very pertinent question what you asked. Indians are traditionally being savers. If we speak about the Indian savings rate, it is in the handle of 30%. If we speak about household saving, it is roughly in the range of 18 to 20%, depending upon which year you are looking at. Now, what is our endeavor is to make sure that we transform the Indian savers to Indian investors. Because the time when we look at only as a saver, we are just looking to beat inflation, and the industry where we are in, we are focusing on creating wealth for our investor. Now, just to give you an analogy about the importance of financial markets in the economy, let's take, a case of a human body. So a finance is like a lifeblood, without which a body cannot operate. And the same kind of, activity which we are doing in the economy, and their asset management companies are playing very, very important role. Just to give a color about the kind of assets what we manage and how we are, not only helping the investors, but also the companies which are into expansionary mode. Asset management industry, which includes mutual fund on the public space and AIF and PMS. Combined, we are managing roughly as an industry around 66 lakh crore. Out of which SBI Asset Management as a company, we are managing roughly 17 lakh crore. This is just the start and the tip of the iceberg. As you rightly mentioned, Indians primarily used to save their money into tangible assets, which were as high as around 70% if we go a decade back, primarily going into real estate and gold. But now over the last 5-6 years, and more so since demonetization, which only got accelerated in the COVID times, we are seeing two big trends which we believe are irreversible. First is the digitization, which is going by leaps and bounds. And second is the financialization. Some of my co-panelists mentioned about the kind of UPI transactions we are happening. We used to be a very, very cash-centric economy, till a couple of years back. And you will be, astounded to note that last month, which was in July, UPI transactions have crossed 10 trillion rupees. So this is the kind of transformation we are seeing, from only cash-centric economy to almost becoming a cashless economy, not only where the large corporates are accepting money in the digital mode, even a small time, shopkeepers, your roadside vendors are now having that kind of a code. So this year for all, in terms of the UPI transaction for the financial year, we are looking at as good as around $1.5 trillion kind of goods and services being paid through UPI. And how our asset management industry trying to penetrate at this point of time, that despite the fact the mutual fund industry is managing 38 lakh crores and remaining 17 lakh crores being managed on the AIF and PMS, the penetration levels are still very, very low, around 2.5–3%. If I speak about asset under management within the household wealth, it is roughly at 5%. But we see this as a great opportunity because, as I mentioned, financialization is only going up, digitization is only going up, and now Indian investors are understanding the virtues of investment, and that too with a longer term. Just to support my point, if you would have seen, this particular calendar year, and in fact, starting from the last October, we saw major withdrawals from foreign institutional investor, which was to the tune of $25–30 billion. Had it been a normal market, going back to 2008, our market would have crashed, 50–60%, where the withdrawals were only in the tune of $8–10 billion. It is the strength of the Indian retail investor, which not only supported market, but helped us in terms of outperforming the global peers by a decent margin. And in fact, at the lows of the Sensex or the Nifty, whichever way you look at, we were only down by 17%, while the developed countries were down by more than that, in the range of 18–20%, not to mention about some of the emerging markets, which were down by 35–40%. So there is a clear-cut trend which we are witnessing, which is Indian retail investor regularly investing through systematic investment plan, and their trade bodies along with companies like us have played a very, very important role in terms of popularizing the investment, and that too in a staggered manner, and which is helping our country in terms of making sure that the indices or our financial assets are held in a good state. We believe this trend is only going to continue, and it will help not only the Indian corporates which are looking to mobilize money either through the equity route or the debt route, but at the same time we are providing humongous number of opportunities to our investor. Just to give an example, even for the international funds, there is $7 billion kind of an investment which Indian investors have made in international markets, primarily in US. And in fact, we have been requesting regulator to increase that amount. So a lot of action happening in Indian financial markets. And if by immodesty, I may say so, that the Indian asset management industry is at par, if not better than the best of the financial market. In our case, it is US. In terms of the asset management industry, the kind of size what they have, which is at 140% of the US GDP. So we believe long way to go in terms of making it more popularized and making sure that each and every Indian is using asset management product in a rightful manner and hence creating wealth over a longer term.
Great thoughts. Digitization, financialization, huge potential for investors, especially retail investors. And now we are not only just looking at funds to flow into India, but we are also investing. So we are becoming investors. $7 billion is a figure that I took from Amit. Great thoughts, Amit. Let me change tracks and come to you, Khushru, in terms of the regulations. IFRS is one subject which has been a talk of the town and being debated in the this sector particularly for about a decade. But still we see it not getting implemented, though IFRS standards actually provide a lot of comfort to the various investors. So where are we standing today in terms of these standards, and how do you foresee the future on that aspect?
Thank you, Vikas, and thanks to Indo-American Chamber for the opportunity. You're absolutely right, Vikas, that the international financial reporting standards have been in discussion insofar as the applicability to banking and insurance is concerned for a fairly long time. I still remember that the first date which was expected for implementation on banks is 1st of April 2013. And we are still about almost 9 years now after that. Having said this, I think the intent of the regulator is very, very clear. IFRS has been in India for a long time, and the applicability has been there right since about 5-6 years now. However, the application on banking and insurance is very, very complex. It needs to go through a very, very rigid deliberation and discussion before the implementation. It's been a distant dream, but at the same time, it's definitely there on the cards. Regulators are also wanting to see the implications of international financial reporting standards globally insofar as insurance is concerned. Coming to insurance, it's applicable globally from the 1st of January 2023. Having said this, I think the earlier applicability insofar as India is concerned of insurance companies, IFRS 17 could be of 1st of April 2024, or it could be even later than that. But yes, I think it's not too far away. The Indian version of IFRS, what we call Ind-AS or Ind Accounting Standards, will definitely give more credibility to the financial reporting framework for both banking and insurance. As far as banks are concerned, the cost of funds will be positively impacted. And even the international transactions, the cost of international transactions also will come down. India will definitely gain a lot of respect and recognition in the global arena of financial reporting. Now, RBI specifically is going in a very, very phased manner. For example, they came out with guidelines in terms of IFRS applicability in a limited manner. For example, there was a discussion paper for revising the prudential norms around accounting of investments. The new rules largely being in line with the IFRS. The applicability of Ind-AS 109 or IFRS 9 on financial instruments also has to be thought through, because investments now will have to be marked to market, and therefore the implications could be severe. The ECL modeling in terms of provisioning, for example, today in the banking industry, we adopt IREC norms, what we call as international recognition and asset classification norms, whereby the provisions on stressed assets, on NPAs, etc., have been defined depending upon the age, etc., and being provided on a percentage basis. Now, when you follow IFRS or Ind-AS in India on banking, the ECL will take into consideration the past trends and the future trends as well. So not necessarily that when there is a stress in the sector, that the provisions will go on the higher side, but to anticipate as well that what is the future on a particular sector, and therefore the disbursements made in that particular sector will also have to be sort of thought through in terms of, what is the real value, what is the kind of scaling down. Now, IFRS implementation is not very, very easy insofar as these two industries are concerned, which I keep reiterating, purely from the fact that the systems need to be completely fine-tuned to ensure that the numbers that are being reported are reported through the systems. Gone are the days that you can continue throwing out the numbers from the systems under the Indian GAAP or the Indian accounting principles and then convert through a spreadsheet into IFRS. I think the volume of transactions will not permit that. And that's one of the reasons why your systems need to be geared, your capabilities need to be further enhanced. And of course, specifically coming to insurance now, I think most important thing is that each and every contract under insurance will have to be thought through in terms of dissecting what is the element of investment in that particular premium, what is the mortality premium, what is the administration charge, and what is the underlying derivative. So somebody giving a check of premium for about 100,000 rupees into a ULIP scheme doesn't mean that you would account premium straight away as being received. You need to dissect that, and there is a different accounting treatment. And in order to do this successfully within a very short period of time, I think the system needs to be well geared up to do that. Right. Also, actuarial valuation will have to undergo significant changes when you are reporting under IFRS. And certain acquisition costs, etc., also need to be expensed off over a period of time. Taking into consideration the paucity of time, I think I must say that regulators are absolutely on this. As you would be aware, there had been precedences in the past where, and continuing as well, whereby the memorandum financials have been presented by the banking industry, by players in the banking industry, by players in the insurance industry to the regulator. There is a good amount of preparedness, more from a recognition and measurement standpoint. But when we talk about IFRS and Ind-US, I think the real crux of the matter is in disclosures. And therefore, unless the entire industry is geared up also on the presentation and disclosures, it would really not be possible to implement. But yes, the future is not too far away. And I'm very confident that within the next few years, this is going to be implemented and will gain a lot of recognition globally as well. Thank you.
Perfect. So we are moving in the right direction. IFRS will be there and we need to be geared up. I think it's but natural for me to move from accounting and regulations now to the legal side of the business. Parul, this is an ongoing debate that Indian legal system needs to go through a number of reforms. In fact, if you look at the ease of doing business also, one of the key issues has been on the regulatory front, which has pulled down the rankings, especially on the contract implementation otherwise. Huge funds are invested in this sector, banking, financial services, insurance. Where do you see the legal framework from banking and insurance perspective, especially when such huge stakes are involved?
Hi Vikas, apologies for the camera error and thank you IACC for inviting me to this panel. I believe we have a shortage of time. Therefore,
yes, I'm sorry, but just 1 minute.
Yeah, I believe that's right. So to give a summary of what are the issues involved in enforcement of contract, the first reason is the slow and inefficient civil judicial system that we have. As opposed to 100 judges per million in US, what we have is 20 judges per million in India. The second reason is the theory that is currently being followed by Indian courts is efficient resolution of contract, which is granting of damages is a better solution instead of enforcing the terms of the contract. The third reason is inadequacy of the training amongst the judges at lower levels, where the contracts are usually enforced, and the reason being the less sensitivity towards contractual disputes and commercial understanding in terms of various contracts. And the fourth most important reason is procedural complexities and cost involved. Now, while I quoted the problems, there's something that we need to understand and stress upon is the intention of the government of India to move towards an efficient mechanism for enforcement of contract. In past few years, while in 2014 we were ranked at 142nd place, in 2020 we were ranked at 63rd place in terms of enforcement of contract indicator. Now, what are the reasons? The government is receptive of the idea that it is important to manage the legal regulatory enforcement regime to ensure that the investors are comfortable coming to your nation. To address these concerns, the government have come up with various schemes and laws which have been enforced in the past couple of years.
Perfect.
Not only has it been made easy for businesses to start, the process have been shortened, the cost has been reduced. Couple of more relevant changes in legal system would be the Commercial Courts Act,
Right.
which provides mechanism.
I am being told that Honorable Minister is waiting on the other side for the next session. Therefore, I know you have some very valid points which we'll touch base, and we will take it to the chamber, to the regulators on the legal side as well, and Khushru from the accounting and the regulatory side as well. I would like to draw this session to a close and would like to thank once again Dr. Ryan Engen, Shanti, Mr. Kanan, Amit, Khushru, and Parul for a very interesting discussion. I think we could continue for next few hours as well, keeping in view the depth which these experts bring on table. And if this panel was a company and I was a shareholder in that company, it will be a multi-trillion-dollar company, and I would be a rich man, Amit, which I will consult you in terms of the investments.
Thank you.
Thank you very much. And Parul.